Hello, Stephen Cruz here, mortgage broker with Verigo iMortgage Solutions. And this is the fourth video in the series that we talk about 8 costly mistakes home buyers make when they're arranging financing. So we covered the pre-approval process, not getting pre-approved early enough, and we covered a little bit about the interviewing more than one lender. And so today what I wanted to talk about is understanding lender penalty calculations. This is something that a lot of people just don't notice that there's a difference, especially because most lenders will say, you know what, you're going to pay the greater of 3 months interest or an interest rate differential when you pay off the mortgage. And the penalty calculation is the key. Some lenders will calculate the penalty and it's substantially more expensive than other lenders in the way they calculate it. So one of the questions I get all the time about penalty calculations is, well, why do lenders pay penalties anyway? And really the way that mortgages work in Canada is that most lenders, whether they're banks or smaller lenders, what they do is they package together a collection of mortgages at a certain interest rate. So they usually do like a $10 million package or something like that. And so they get a whole bunch of mortgages in place at this package, and then they sell the mortgages to an investor. So the bank has $10 million, it invests the money, sells it to an investor, and they administer it to make sure the investor's generating this return that's guaranteed from this investment, and they get $10 million back again to do the process again. And so the bank is facilitating and administering this package of mortgages, but they're not necessarily the investor. Sometimes they are, but sometimes they're not. And so when you want to break your contract, so you write a contract for a 5-year term at a guaranteed interest rate, and then you say, you know, I'm selling my house, so I want to pay off this mortgage. If the bank has guaranteed an investor this rate of return, then they have to be able to capture the lost revenue that your mortgage inside that would be. And so they're going to charge the difference. And the interest rate differential is typically calculated as the difference between what they would recover their money for to give back to the lender. And 3 months interest penalty I think is basically there just to dissuade you from paying out the mortgage, because it takes them some time to guarantee this return, to replace the mortgage with the other one, because there's a package of mortgages there. So that's just kind of an admin fee to make sure that they can do the switch out, this and that. But the IRD calculation is substantially different with some banks versus others. And I'm not sure I fully agree with the way some banks calculate that penalty, but you know what, that's up to them and their investors, and that's why some of them show huge profitability. But knowing which bank offers what calculation will help you to decide if both banks are offering the same interest rate. So in this example, I show 3.05%. If they both have exactly the same interest rate, but one bank's calculations are substantially more than the other, which one would you prefer? Now, one bank might have, you know, an infrastructure and branches that you can go to, and you may be willing to pay that extra money to have those services, and you may not ever have to pay that if you don't want to pay out the mortgage early. So it's just important to be aware of and know how that works, so that you're fully informed and you don't get a surprise down the road if something happens. So this is the 4th video in the series. I'm Stephen Cruz, mortgage broker with iMortgage Solutions, and thanks for joining me. And we'll be up next with the next video. You have a great day.